Hey, what is going on, guys? My name is Nick, and in today's video, I'll be sharing 3 common investing mistakes that you need to avoid at all costs. And yes, I am personally guilty of all of these mistakes, which is why I'm here teaching them to you so you don't have to learn from making your own mistakes. In fact, I'll be sharing specific examples of stocks that I bought and sold to illustrate the concepts. And all I ask in return, guys, is for you to drop a like on the video. It really does help me out, and I truly do appreciate it. And if you haven't already, definitely consider subscribing for more investing content coming from my channel in the near future. So with that said, let's jump into these 3 investing mistakes that you need to avoid at all costs. All right, now the first mistake you need to be aware of is something that we do called price anchoring. As investors, we tend to get fixated on the cost basis of an investment and the price that we bought that stock or ETF. Now, while the cost basis of an investment is a very important factor, it shouldn't be something that we get hung up on, and it can actually cause a lot of problems. So in essence, price anchoring is just getting fixated on your cost basis, and it ends up making you do a move or not doing a move simply because of that cost basis. So now I'll be sharing 2 different scenarios in which I made mistakes because I was caught price anchoring. First of all, I bought Microsoft stock back in 2018 for about $106 per share on a small dip. Now, I only invested about $1,500 US just in case the stock would drop further, so then I could further build out my position. But basically, as soon as I built out that small position, the stock started moving up again. And because the stock moved above my cost basis, I refused to buy any more of the shares because I felt like I could have loaded up on the shares right at that original price that I bought in, but now it was so much higher, so there was no point. I didn't care about the fundamentals of the stock or the fact that it could have been undervalued. All I cared about was the fact that I was buying above my cost basis, which felt like a crime to me. Now, looking back, we can all see how stupid of a mistake that was, since anyone would love to have bought Microsoft above $106 per share, say at $130 or $150 or even $200 per share. Moral of the story is you should only be concerned about the current valuation and fundamentals of the stock that you're buying, not the price that you bought into it. Other than for your own bragging rights and for your portfolio to look pretty, the cost basis means absolutely nothing towards your investment thesis. I've since learned this lesson with Facebook stock, where I continue to buy the stock whenever I feel it's undervalued, which ends up being above my cost basis, and this has ended up proving to be very profitable, and it's turned out to be basically my best stock so far. But the same type of mindset can go the other way around too when a stock drops. I started buying CCL stock right before the global pandemic happened, and needless to say, that ended up being an unforeseen mistake in itself. Anyways, I had a cost basis of around $40 per share, and when the stock started to drop, I continued averaging my position down because I felt the shares were cheap, only because they were below my cost basis. But the stock just kept dropping and dropping like a falling knife and fell all the way to below $10 per share, in which I basically completely stopped buying. Now, you should keep in mind that during the pandemic, CCL was basically making 0 revenue or 0 sales, and then also their losses were in the billions per quarter, so there was no actually saying if this stock was undervalued or overvalued or what the fair value was. Not to mention they were diluting shareholders like crazy just to be able to stay afloat, pardon the pun. So the point here is that just because a stock falls below your cost basis doesn't mean that it's worth buying into, and it doesn't mean that it's undervalued. Buying the dip can lead to deeper losses in your portfolio if the fundamentals aren't there to support the stock price for that company in the future. Nowadays, CCL still hasn't recovered from the highs in 2019, and it probably would have been better for me to wait for the bottom rather than trying to average down as soon as possible, because there was no guarantee that it would come back up. Overall, focusing on your cost basis just causes a lot of problems when you're investing. And it happens both when the stock rises or the stock falls and you focus on the cost basis, but rather you should be focusing on the company's valuation, their fundamentals, and if it's worthy of buying or selling. All right, onto the second huge mistake that I'm very guilty of making is taking short-term profits. Now, I realize that in the US, you're incentivized to hold your investments for at least a year to achieve that long-term capital gains tax rate, and if you sell earlier, you have to pay more in tax, but here in Canada, it's not like that. Regardless of the taxation rules though, we shouldn't be so quick to take short-term profits if we have a long-term investor mindset. Taking short-term profits can lead to missing out on huge amounts of gains just because you aren't patient enough to ride out the investment. Now, an example again for me was when I bought Microsoft at $106 per share back in 2018. I thought the stock had risen too quickly in a short period of time, so I ended up selling at $155 per share just over a year later, locking in a profit of just about 50%. Now, the stock did end up dipping back to the 130s during the beginning of the pandemic, but then after that, we can see it just skyrocketed and never saw those prices ever again. If I had held on to Microsoft stock until today, I would have made about a 200 200% return on those initial shares, just because the price is about $300 right now. Another example is when I bought into Amazon stock back in 2018 as well. I bought at an average cost basis of about $1,825 per share, in which it quickly dropped to about $1,300 per share in the market sell-off of December of 2018. Now this really freaked me out at the time, as I was a new investor and volatility wasn't something I was used to. So as soon as the stock price rebounded back up to $1,825 per share or thereabouts, I sold the stock because I was worried that it was overvalued and that it could drop all the way back to $1,300. Again, we can see what a huge mistake that was in the past, and Amazon sits around $3,300 today, which would have nearly doubled my money. So basically, when you have an investment thesis that spans out for many years for that company, don't be so quick to take the profits. Let your investment thesis ride out and allow that company to grow, because it's going to be a long-term investment at the end of the day. Now, sometimes the valuations will get pricey, but as long as the fundamentals are intact and that business is still growing like crazy, it doesn't mean it's time to sell. Overall, guys, holding for the long term can generate much higher returns rather than buying and selling out of stocks very quickly and all the time just to generate those short-term profits. Now, the third and final mistake that I've made in the past is having a lack of confidence when it comes to my investments. Naturally, when you first start at any skill, you're not going to be the best at that, and you're probably not going to be that confident in doing well. But as time goes on and you develop your skills and experience, you become much more confident in the outcome of your actions. Now, this certainly applies to investing, because we might not be that confident in our first few investments or stocks that we pick, but then as we see the winners and losers in our portfolio, we begin to understand what works and what doesn't. Now I've learned that being confident with my investments, or in other words, placing big bets on what I strongly believe in, ends up paying a lot more in the long run rather than evenly diversifying my portfolio among all of the different investments. And this is arguably Warren Buffett's approach to investing that I spoke about in my video on diversification, where he believes only owning a few great businesses is enough to make you rich for a lifetime. For example, what I did was I invested a small amount of money into Facebook stock, which was $1,800 US or somewhere around there, and this was right after the Cambridge Analytica scandal happened. But as soon as I started buying into the stock around $180 per share, it continued tanking for several months, which went down another 30 or 40%. Now, although I had done all of my research on Facebook stock and I knew that the fundamentals were completely okay and they had tons of cash, like, I mean, $50 billion of cash on their balance sheet or something like that, I still did not even buy the dip because I didn't have the confidence in my investment. Sure enough though, the stock quickly recovered to previous all-time highs after a few months of negativity surrounding the stock, and if I had a little bit more confidence in my investment and bought the dip, I would have over doubled my investment by today. However, I am proud to say that ever since, I have placed a lot more money into my higher conviction investments. Later on, as Facebook stock was around $250 to $260 per share in early of 2021, I saw a great opportunity as the stock valuation looked incredibly attractive with great fundamentals. I knew that advertising was going to rebound further coming out of the pandemic, and I knew that Facebook was going to benefit substantially. So I ended up tripling down on my initial position in Facebook that I had from several years prior. So not only did I buy above my cost basis, but I also tripled down on my investment position, making it one of the biggest positions in my portfolio. And my cost basis rose from $180 per share all the way to something like $225, which was just below the current stock price. But with Facebook stock trading around $330 per share right now, I would say that my confidence earlier this year has certainly paid off. And going a little bit off topic here, I currently think Facebook stock is still undervalued at the current prices, so I am continuing to boost my position size and raise my cost basis because I just think the fundamentals are still amazing and the price is undervalued. Overall though, it literally pays to have confidence in the stock market. Thinking that you're right, even if other investors are selling, is actually a very scary thing to do. But it does pay to have that confidence, and if you've done your research, you understand the fundamentals and the valuation, then just go for it. Anyways, I really hope you enjoyed that quick video of my investing mistakes. And so those 3 mistakes are price anchoring, taking short-term profits, and then having no confidence in the market, all of which you should definitely avoid. But let me know down in the comments section below if you've ever had a situation like this. Have you price anchored? Have you taken short-term profits? Or have you had a lack of confidence? Let me know. I would love to read it. Anyways, if you did enjoy the video, make sure to drop a like as it does help out my channel. And then if you haven't already, make sure to subscribe so that you don't miss any future uploads from my channel. And with that said, I will see you guys in the next one.